So you may have noticed that your 2026 tax bill has gotten a pretty big overhaul. Some of your favorite deductions are gone, and a few changes that were supposed to be temporary just became permanent. And if you're a high earner, a lot of these changes are going to hit your wallet in ways that you might not expect. Hi, I'm Bjorn Amundsen, a certified financial planner here at Quarry Hill Advisors. We work primarily with corporate executives, business owners, and other pre-retirees who are navigating complex financial decisions as they approach retirement. And look, I'm not going to sugarcoat this. The One Big Beautiful Bill Act changed a lot of the rules that we've been playing by. Some of these changes are wins, and some are losses, and some of them are just complicated. So in this video, I'm going to walk you through the 6 biggest changes that actually matter to high income earners, and more importantly, what you need to do about them. So let's dive in. So the first up is the state and local tax deduction. This is called the SALT cap. You've probably heard about this one because it's been controversial since 2017. What it was a limit on the amount of taxes that you pay to the state that you could deduct. It was limited to $10,000. This is a big deal for people in Minnesota, where a lot of the time your property taxes alone can be more than $10,000. And the cap was supposed to expire completely, but instead they modified it. In 2026, the deduction cap has now increased to $40,400, up from $40,000 last year. So this sounds like good news, right? Here's the catch, and this is important. The expanded cap only applies if your income, your modified adjusted gross income, is $505,000 or less. Now, if you're married filing separately, that threshold drops to $252,500. So what happens if you earn more than that? Well, the deduction is going to phase out at 30 cents for every dollar you earn over the limit. So once your income crosses $606,000, your state and local tax deduction is going to snap all the way back down to $10,000. So here's the bottom line. If you live in a high tax state like California, New York, or Minnesota, where I'm based, and you're making $500,000 or more, you're probably not going to get much benefit from this expanded cap. It's basically a middle income tax break that high earners can't fully use. So next, let's talk about business deductions, specifically the famous SUV tax loophole that business owners love. The Section 179 is still alive and well. In 2026, you can deduct up to $2.56 million in equipment purchases. So if you buy some business equipment, vehicles, machinery, you can still accelerate those deductions. But what changed? Bonus depreciation has dropped to just 20% for 2026. So if you remember, a few years ago, you could depreciate 100% of certain purchases in year one. That's been phasing down, and now it's all the way down to 20%. So what does that mean practically? It means if you buy a heavy SUV that's over 6,000 pounds for your business, you can still use the Section 179 for about $31,000. But the bonus depreciation that used to give you a huge first-year write-off is mostly gone. There is one bright spot, which is that the IRS has set the business mileage rate to 72.5 cents per mile in 2026. So if you're tracking business miles, that rate can help you offset some of the lost depreciation benefits. Next up, here's some genuinely good news. The estate tax exemption is now $15 million per person, or $30 million for married couples, and it's permanent. So if you were paying attention in 2025, there was a pretty huge panic because this exemption was supposed to be cut in half. Estate planning attorneys were swamped with clients who were trying to move their assets before the deadline. Well, Congress has made those high exemption levels permanent and indexed them for inflation. So if you've been putting off estate planning because you were waiting to see what would happen, the waiting is over. The rules are set. But don't misunderstand. This doesn't mean estate planning isn't important anymore. If your estate exceeds these thresholds, you're still facing that 40% tax rate on everything above that amount. And a lot of people forget about the life insurance they have or the businesses, and so you need to include all those things. And even if you're under that threshold, proper estate planning is about more than just taxes. It's still about protecting your legacy, avoiding probate, and making sure the assets go where you want them to go. Now, before we continue, I want you to know that figuring out how all these changes apply to your specific situation can be overwhelming. And you might be wondering, how does this affect me? And am I doing it right? Well, that's exactly why we offer a complimentary financial review for interested executives, business owners, and other pre-retirees. We'll walk through your situation and show you just exactly where these new tax rules apply to you. Just go ahead and click in the footer to schedule a meeting with myself or one of our advisors. All right, let's keep going. Next is that the qualified business income deduction is here to stay. So this is a big one for business owners and anyone with some sort of pass-through income like an S corp or an LLC or a partnership. Remember how the state and local tax exemption was limited to 10,000 for high income people? Well, for people who own one of these types of businesses, you can have the business pay some of those taxes to your state for you. So the qualified business income deduction, that 20% deduction that you get for these types of businesses, it was supposed to expire at the end of 2025, and now it's permanent. And not only is it permanent, but the phase-in ranges got wider. So in 2026, if you're married filing jointly, you're not going to start seeing limitations on your deduction until you hit $394,600 in taxable income. And for service businesses, so think about doctors, lawyers, consultants, or architects, that cliff used to be really steep. Now it's a much more gentle slope all the way up to 544,600. So the bottom line is if you own a business structured as a pass-through entity, you can continue planning around this 20% deduction. It's not going anywhere. Next up is the Roth catch-up rule that nobody wanted. All right, this one's been frustrating a lot of high income earners, and I'm going to be honest with you, this is probably the most painful change of 2026. So here's the rule. If you earned more than $150,000 last year, it was $145,000 previously, all your age 50 catch-up contributions to a 401k must go into a Roth account. So let me explain what that means. If you're 50 or older, you can contribute an extra $7,500 to your 401k or $11,250 if your plan allows for the super catch-ups. The extra money used to be pre-tax, which meant it reduced your taxable income for the year, but not anymore. If you're a high income earner, those catch-up dollars now have to go into an after-tax Roth. You don't get the deduction today, but the money will grow tax-free and come out tax-free in retirement. Now, Roth contributions aren't inherently bad. In fact, for many people, they're great. But if you're in the 35 to 37% tax bracket and you were counting on that deduction to lower your tax bill, this change is going to hurt a bit. On the positive side, though, you are building up tax-free money for retirement. So you're paying a little more today and you'll have some flexibility later. The last thing I want to cover is charitable giving because the rules change in a way that really affects high income earners. First, there's now a floor on charitable deductions. So that means you can only deduct donations that exceed 1/2% of your adjusted gross income. So for someone who makes $500,000, that means the first $2,500 that they donate, it's effectively non-deductible. Second, if you're in the top 37% tax bracket, your charitable deduction is now going to be capped at 35%. So essentially, you're losing 2% of the tax benefit for every dollar you give. There is also one positive change. If you don't itemize your deductions, you used to not be able to get a deduction for charitable giving at all. Now there's a new above-the-line deduction of $1,000 for singles or $2,000 for married couples filing jointly. So that's for cash donations, and you can take it even if you just take the standard deduction. So what does this all mean for you? If you're charitably inclined and you're itemizing, you might want to consider bunching your donations. So you can give multiple years worth of donations in 1 year to clear that 1/2% floor and to maximize your deduction. Donor advised funds are a great tool for this. Okay, so let's recap everything. The SALT cap went up, high income earners are phased out. Business deductions are still available, but bonus depreciation is way down. Estate tax exemptions are now permanent at $15 million per person, and the qualified business income deduction is permanent too, which is great news for business owners. Catch-up contributions are now Roth only for high income earners, and charitable giving got a new, more restrictive floor and cap. These aren't just minor tweaks. These are pretty big changes to how you should be thinking about your tax planning in 2026 and beyond. So now that you know the major tax changes for 2026, here's the thing. Your situation is unique, and the tax code doesn't operate in a vacuum. It interacts with your income sources, your business structure, and your retirement accounts, and your charitable goals, and your estate plan. So that's exactly why we've created our complimentary financial review for corporate executives, business owners, and other pre-retirees. We'll look at your specific situation, run the numbers, and show you exactly what these changes mean and what strategies make the most sense for you. If you're ready to get some clarity on your tax situation in 2026, click the link in our description to schedule a call with our team at Quarry Hill Advisors. Thank you for watching, and I'll see you in the next one.